Folks, Steve Lentz here with the Inside Wire. Welcome. Let me turn this recorder off. There we go. There we go. Recording is on and we are off. The Inside Wire here. It's April 17th, 2018. Presented materials for educational purposes only. Should not be construed as personalized financial advice. Past results not necessarily indicative of future performance. Welcome, everyone. And we are going to continue with our series on the new revised statistical edge analysis. And so we did parts 1 and 2, of course, and today we're going to dive into another dimension. And again, I appreciate Brian Johnson being with us. And you know what? I might even, last week I gave Brian's website info, and Brian, I don't think I made it into this one, unfortunately, but we'll have you put in your credentials or your website down there. That'd be awesome coming up. All right, so parts 1 and 2, we're really endeavoring to revise our statistical edge analysis approach. And what I've been doing every weekend in my likelihood report is reporting on the probabilities of various price distribution bands getting struck in the future, in the past on a historical basis with the broad market and then specific to a given market condition. And so what we wanted to do was move to something more concrete that I think more traders can really bite their teeth into. And so we really need a better way of documenting and quantifying likely direction of the market and its volatility based upon past occurrences of the same market condition. Before, we were using price distribution bands, which was great for calculating the probabilities of credit spreads succeeding, something like that. This is a more direct approach that could be used by far more traders than just credit spread traders. So what we came up with parts 1 and 2 was having 2 parts to our report: the average rate of change, both 5, 10, and 15-day looks into the future. And then we went with standard deviation on part 1, but switched it last week in part 2 to having an annualized historic volatility, or what we're going to call realized volatility, 5, 10, and 15 days. And Brian Johnson, who's with us here today, sent out a great email that we went into last week. And part of the email asked for a Z-score getting attached to the same report. And so we're going to proceed today and discuss the Z-score and really why it's needed in a report like this, if we're really going to have a meaningful understanding about looking at past occurrences of the current market condition and what it could mean in the future. So, and again now, and Brian, go ahead and if you want, could you just in the chat, Larry, put your website down. Brian has written a couple books, and he has a great website. It's a great blog that he puts out, and some great resources there. He's a partner with OptionVue distributing and everything. So, Brian, if you could, it's traderedge.net. That's excellent. Thank you. Go check out the website. Brian does a great job there. So if you look at the broad S&P 500 market going back, and this is the market we address right now using statistical edge analysis, and this is the example we're using, and it's the report I put out every weekend. The market has clearly gone up since January of 2000. We've had some bearish hiccups in there, but January of 2000 is about the best place to start that encompasses as much bearish activity to balance the preponderance of bullishness that you see here. And the idea is that we want to establish a baseline rate of change. If you have a market condition that appears bullish, and then you go and look at how far in the, how many times in the past it's turned out to be bullish, well, that doesn't mean anything if the market is, in broad terms, has been bullish a long time, because you don't really know what edge that you're given your potential signal, the market condition you're looking at that could be bullish. You don't know what kind of edge it has over just simply randomly picking a bar knowing that in the long run it's likely to turn out bullish. And so when we go back and look at the S&P 500, going back to Jan of 2000, you know, there's pushing 4,600 closes since then. On average, from one close to the close 5 days later, you have a gain of roughly 0.1%. All right, and the average 10-day change is almost 0.1%, 0.19, and then the 3-week change is not quite a third, it's at 0.29, just barely short of 30%. All right, so that is the baseline rate of change looking at all 4,577 bars going back to then. Okay, so with that in mind, let's now go take a look, and we're just going to use the same example we used in parts 1 and 2, and that is we're looking at March 2nd, 2018, when we had a big down day there, and it kind of made new lows going way back several weeks, and it was very alarming for a lot of people. And as I said before, I was in on a panel with other analysts, and I was able to take my research here and come up with the notion of being bullish moving forward. A lot of them were saying new lows were broken, I'm bearish, and I was counter to them because of this research. And so what I did is I put into my Metastock engine that I've created to do this, the market condition as I'm defining it. And I'm defining it in 3 dimensions: price action, trend, and then the stochastic situation. So, and I look at price action in terms of 2 bars. We have an upswing and then a downswing. All right, today was a downswing, yesterday was an upswing, and in this case, where it's really pronounced, I'll go ahead and say that the true range, it should be just simply the true range percent is above 1%. Because that's a pretty fat bar there. And so when you just take an upswing, then a downswing, and go back, you know, you want to kind of make it more specific in that the market condition here is that we just experienced a very wide bar. All this is happening when we're underneath a simple moving average, a 50-day simple moving average. And in terms of the stochastics, it's between 10 and 50, and below, it's barely below its %D there. When you put all this together, I think there was something over 41 or so incidences of this precise market condition going back to Jan of 2000. So that's the market condition we're using as an example. And so now, if we look at the rate of change, and we're working our way towards an understanding of z-score, all right, that's where we're headed here. So we have the baseline rate of change, and when we take the 41 incidences of our current market condition and go back to Jan of 2000 and look at each of those 41 occurrences, and by the way, that 41, that's not even 1% of all these, you know, from the huge population we have. What you'll find is that the average 5-day change from amongst those 41 incidences, the 5-day average change was 0.59%. Okay, almost 0.6%. The 10-day rate of change was about 0.75%, and the 15-day change actually went down to 0.32, which is interesting how it declined from the 10-day average change. Now you can see the differences. We're taking the differences. If baseline's at 0.1, and then the 5-day, you know, from our sample of 41, the difference, 0.59 minus 0.1 is 0.49, almost 0.5% difference. Almost 0.5% difference. And the question on the table now is, you know, I mean, so what? All right, I mean, yeah, that's about 5 times the positive change. I mean, do we interpret that in terms of being just an absolute value? Yeah, 0.6%, is that a lot? Or do we look at it in terms of 0.1 being a positive, and this is several times that on top of it? Well, we need a way to take a peek at this. And so I also, oh, and by the way, I also carved this out in terms of price exceeding the previous day's high. So we have our market condition, right? So the next day, if the price ascends above the high here, okay, the distribution is going to be a certain way, and then if price goes down below the low, the distribution or the rate of change will be at a certain level. And so what I do is I carve this up. If the next day comes and price goes up above there, I want to know what the average rate of change is for that situation, and then if it goes down below what it is for that situation. And that's what I've carved out here. If it goes above that day's high, we can see here, boy, I mean, there's a gain of 1.3. Now, that only happened 6 times. And then over here, if it goes down below the low of that day, well, that happened 33 times in the past. And then, of course, you have a smaller gain to the upside. But is that 1.3? That looks like it's astoundingly greater, certainly, than just the 41, and certainly a whole lot more than if the price goes down below. But the question is how significant are these differences here? And this is a difference of 1.2%, almost a 2% difference. Look at this over here. Yeah, almost, yeah, and there it is, another almost 2% difference in this case from the benchmark. So to answer this, we have to look at something called z-scores. Z-scores, and it is a statistical term in the arena of significance, I guess you could call it. So let's just talk about understanding z-scores and what they are. And so what we first have to do is take a look at the standard deviation, all right, of the rates of change. So when we look at the baseline, going back almost 4,600 bars, and we look at the average 5-day change of 0.1, all right, there is a deviation from the average there. In this case, that's at 0.81. And in part 1 of this series, I talked about standard deviations a lot. I'd suggest you go back there and look at that methodology in terms of what is a standard deviation and how to derive it, and I take you through the spreadsheets and all that stuff. But it's basically looking at the variance of the data points from the mean, and basically it's a way of looking at the volatility of the data points that derived this average. Okay, that's kind of what you're looking at, and you can see here it went up to 1.15. 1.39. Okay, and this is in terms of percentages. 0.81 of 1%. 1.15 is 1.15%, 1.39%. So that's the first step. And here's the most important slide of the presentation today. Okay, look above here. From the close, all right, so we're just looking at those 41 incidences where we had an average 5-day change of 0.59. Okay, the difference from the base is 0.49. So what we're going to do then is to determine the significance of 0.59 and how far it is away from the baseline of 0.1. We're going to look at a z-score, and a z-score measures how far a data point is from the mean expressed in terms of the standard deviation. Because 0.49, 0.5%, yeah, I mean, that sounds pretty good, but really, how significant is it? Well, look over here. When we look at the 5-day standard deviation of 0.81, okay, that 0.49 is something just barely over, half a standard deviation to the upside. It's within a 1 standard deviation, from the mean of 0.1. All right, and that kind of gives you a feel for how significant it is. And so when you actually take 0.49 divided by that standard deviation of 0.1, you get 0.6. So that's basically 60% of 1 standard deviation to the upside. It's over half a standard deviation to the upside. Okay, and so here's the formula for getting it. You take the data point, 0.59, minus the mean, and I'm doing it down here, okay, gives you a value of 0.49. divided by the standard deviation of 0.81 to give you that value. Now let's look at the other ones. Here's a 0.74, that's 0.55%. That's not even half a standard deviation away from the mean. Okay, and then look at this one. Yeah, we're at a 0.32 to the upside, but the mean is at 0.29. It's almost flat, so the z-score is pretty much very close to 0, meaning it's very close to the mean. It really is not significant. Now let's take a look at these numbers. Look at this. Okay, now this happens 6 times where price went above that day's high. That that big bar that we saw where price went up above the high of that bar the next day. Okay, the 5-day change then was at 1.30 minus 0.1. That gives us a difference of 1.2 divided by that 0.81. Look at that. We're almost 1.5 standard deviations from the mean there. That's pretty significant. Okay, now unfortunately there's only 6 items in the sample. Okay, we'd feel a lot better if there were more than 6 items in the sample, right? But then you can see that these numbers it just basically tells you how significant it is relative to being to the standard deviation here. And so if you're over 1.0, that means you're more than a standard deviation away from these baseline average rates of change. And your ears are going to perk up a little more when you're at over 1.0. If you're down there closer to 0, 0.5, 0.3, I mean, you're well within a standard deviation. It's not as big a deal. Let's go down here. We can see this is what we have now, z-scores of 0.35, 0.3. And here now is an example where we're going the other way. Look at this. If the benchmark change is 0.29, and here you could see that on average of these were like 33 data points where it exceeded the low. On average, then for 15 days you had no change, 0.00. Okay, that's actually 20.29% underneath the mean. Now you're at minus 0.29. You take minus 0.29 divided by 1.39, you get a minus 0.21. You're basically about a fifth of a standard deviation to the downside. Okay, that's kind of where you're at. And then likewise, if we had a minus 1.0, that means that we would be 1 standard deviation underneath the mean. That'd be quite bearish. Anything over a minus 1.0, your ears should perk up, and you should really take a look at that. Okay, and you would give more significance when it is above 1.0 or below minus 1.0. Okay, and then I'm showing you here a slide where we are adding in realized volatility. We discussed this last week. We're putting this into the report. And here is the new report, which has now the rate of change. I'm showing the z-scores, the significance. We have realized volatility. That was a term we talked about last time in terms of it being, we were bouncing around statistical volatility, actual volatility, historic, and Brian had an idea, and he uses this as realized. And that's exactly what we're talking about, is what volatility is realized into the future. And what I'm going to do here, too, is start maybe removing these differences, except when I teach this. Just remove these, and then what we'll get then is just a cleaned up version down here where we're going to presume that the reader understands z-scores after going through this. That way you don't get there's just fewer numbers on the screen that you can really focus in on. Okay, now let's just take a look at what happened yesterday for those of us here. From the close of yesterday, let's take a peek. Here was the market condition in the S&Ps. We had an upswing bar that occurred after an outside bar, higher high, lower low. Yeah, that's price action, and I wanted to get more than just a few data points here, so I had to adjust the moving average to a 25 simple moving average that we popped over, because this combination of price action and stochastics below the 50 just doesn't happen very often. It didn't happen enough to give a meaningful sample, so I adjusted the moving average, bumped the sample size up, and because here you have a stochastic, we're between 60 and 100, and we're trending upward, and we're above the 25 moving average there. But it's that price action that just doesn't happen that often, with an outside bar followed by an upswing. And so when you look at all of that, we have a count of a total of 78. So here's the report for yesterday. You can see that, and here's our benchmark. Okay, and then you have the 5, 10, and 15-day rates of change for this current market condition, which occurred 78 times. The z-scores are pretty flat, you know, at a quarter of a standard deviation to the upside. Okay, and then now if the market goes above today's high, you can see here that the z-score now goes and it's pushing 1. Okay, and here it's not even half, 0.35, so it kind of you know, gets reduced a bit. Now if it goes below today's low or yesterday's low, you can see similarly z-scores well under even 0.5% or half a standard deviation to the downside there. In terms of volatility, in all cases except one, you have the realized volatility being underneath the baseline. So that's kind of interesting, where you have the baseline realized volatilities in the 15s up to 16, and here you have, these are all in the 12s and 13s. Here's a 14, and then of course down here, if it goes down, you'll be in the 15s there. So kind of the same as the benchmark, but a little bit lower depending on the situation. Okay, so that's it for us today. Any questions, comments? Again, check out Brian's TraderEdge.net website. Some great resources there, great articles. All right. Okay, folks, thanks so much for joining us. Again, if you have any ideas for the Inside Wire in the future, shoot me an email, steve@optionvue.com. Be glad to take a look at it. Take care. Have a great rest of the day. Bye-bye.